Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Austin Wiley. Austin is the CEO of SKY Leasing. He's joining us for the purpose of our Aviation Leaders Report 2025, and we're recording this in the middle of October 2024. Austin, thanks for joining us again for the purposes of the report. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Sky?
Sure. SKY Leasing is a privately held alternative asset manager. We have about $5 billion in assets under management today, and we focus on acquiring primarily new technology and younger current technology aircraft using both sale-leaseback and secondary market acquisitions.
Excellent, Austin. And maybe when we start off, we might talk to the customer and demand environment. Can you talk to us about how that's evolved over the course of 2024? And are you seeing any interesting trends from a geographic perspective on the demand side?
Yeah, I mean, when you look at it in the whole with the most recent IATA data, 12% RPK growth through August, we feel very good about that. But when you unpack that 12%, it's coming from a different source than in prior years. So Asia, of course, one of the slowest recovery regions, is now continuing to really perform strongly. But increasingly, we're seeing international traffic and long-haul traffic really accelerate. And that actually is growing at nearly twice as fast the domestic market. So as a year ago, where we would have seen the domestic market start to slow down, we're really seeing that offset by long haul and international traffic.
And so a strong demand environment, which I think reconciles with what we're seeing, as you say, in those numbers. Would you have concerns as you look around, kind of whether it's geopolitical risk or the more wider macroeconomic environment, as to how that market might turn going into 25?
Yeah, I would say that we feel very good about the supply and demand dynamics in the market. A year ago, we had quite a bit of concern about softening leisure demand in the U.S. market. And when you look at what the U.S. carriers have done through deferrals of orders, through fleet reduction initiatives, somewhere in the neighborhood of 100, 150 aircraft have been taken out of the U.S. market, and we're seeing stabilized ticket yields in the region as a result of that. From a geopolitical macro perspective, the economy has certainly outperformed our expectations, and we'll take it. And so we feel very good about that, and that's really kind of lower on our risk radar than in prior years. And geopolitical continues to be elevated, but we really manage that through just maintaining diversification in our investments across regions and watching our country exposures in areas that could be more exposed to those geopolitical events.
Yeah, and is that driving any behaviours as to where you're trying to place aircraft on the geopolitical side or not?
Not really. I think, where we're seeing the most opportunity is really airlines that are facing the challenges with the OEMs, right? They didn't build a business plan that allowed them to absorb now 2 and 3 and even more longer delays in terms of aircraft deliveries. And so as a result of that, they're shifting their extension expectations, they're taking on current technology aircraft. And so while geopolitical factor is always a discussion in our investment committee, it's not the driving decision at the end of the day for where we put aircraft.
Yeah, and you referenced the supply dynamic that we're in. We're obviously, very challenging place that Boeing's in. We have production rates even on the Airbus side that probably aren't where they were pre-pandemic. Can I get your take on how that's impacting Sky's business when you look at that supply side dynamic, and just how do you see that evolving over the medium term?
Yeah. When you look at planned production pre-COVID to actual production, it's now north of 5,000 aircraft and growing, right, with the challenges that Boeing faces today. And we really call that the great supply reset. And that supply reset is causing current technology aircraft and the replacement cycle to be shifted out, not just a couple of years, but really through the remainder of this decade and now well into the 2030s. And so we've shifted our approach to investment to where we're owning a higher percentage of current generation aircraft, but we're doing it maybe in a different way than others, where we're targeting aircraft that we can get long-term leases with. So we still want to generate the majority of our return from contractual cash flow, and we're careful in selecting the airlines that we think have the capabilities and the business model to operate these aircraft for a very long period of time.
And you mentioned then what that should feed into, you would think, is a heightened lease rate environment. Can you talk to us about what you've seen in the evolution of lease rates over the last 12 months or so? And I know you've got a very young fleet, and maybe it's not into extension requests as of yet, but your take on what the extension market is like.
Yeah, we're seeing airlines overwhelmingly want to extend, and every conversation that we have with the airlines is, they need to maintain excess aircraft in their fleet to be able to absorb and not be exposed to delayed deliveries and the aircraft being on the ground as a result of early removal for the engines. And so as a result of that, we have a high conviction in investing in these assets. We're seeing lease rates up anywhere from 10 to 20%, depending on asset type and vintage. And it really comes down to the engines. And it's pretty clear that the airlines want to extend after the first lease. And then when you get to that second lease around year 15, year 18, it comes down to, can the asset manager be creative, optimize the green time that's remaining on the engines, and create a compelling solution for the airline to want to keep that aircraft longer.
And then maybe if we move on to the trading environment. So you have a supply challenged overall environment. And trading has, I think when we've been having these conversations over the last couple of years, it's been sluggish compared to where it's been maybe, again, going back pre-COVID. Yeah. What's your take on the trading market and its health, and what's that driving from an asset value perspective?
Yeah, I think we are seeing more trading activity when we look at the percentage of origination from direct sale leasebacks versus trading. We are getting a higher percentage from trading than prior years. That's a result of a couple factors. One, higher lease rate expectations, higher residual value expectations. Two, peak interest rates and interest rates coming down, and also margins coming down for ourselves and others, and ultimately our expectation of how long these aircraft will operate. So those three factors are really, in our view, driving trading. From a seller's perspective, they're managing their own debt refinancings, their own portfolio metrics, and so we do expect a healthy trading environment over the next 12 months, and probably will increase from where it is today.
And do you see kind of from a SKY perspective, you guys being net purchasers, net sellers? Might depend on the transactions, I suppose.
Yeah, I would say net purchasers. Look, we're still focused on growing our fleet. We have launched a Fund 6 just a year ago. It's got 51 airplanes in it. We have plans to grow that to north of 80 over the next 24 months. So we'll be a net acquirer of assets.
And you mentioned interest rates there. And again, when we were having this conversation last year, we'd gone through that whiplash of kind of 22 into 23 with the significant rate rises and the pace of those rises. And now we're in an environment where we're starting to see them recede.
Yeah.
Can you tell me, when you're assessing the interest rate environment, how is that impacting on your business plans, and what is your outlook going into next year?
Yeah, when you look at whether it's the 5-year Treasury or 5-year SOFR, we've largely been range bound over the last 18 to 24 months, around 3.5%, 4.5%, depending on the economic data and what the Fed is saying. And so we're not changing our base case interest rate assumptions. The biggest impact, I would say, to how we view our cost of funds is the normalization of aviation risk in the minds of bond investors and bank debt investors. And so, risk premiums were quite high coming out of COVID. Then you layer on Russia, Ukraine, and the uncertainty related to that. And we've seen those come down dramatically. And so the biggest change is, in fact, not really benchmark rates, but actually our spread expectations. Yeah. And not that we're expecting them to get extremely tight, but really normalizing back to where they would have been in 2018 and 2019. Yeah,
that's interesting to hear. And there's one point I was going to probe at, that spread piece is just really important. And you've got that trade-off between, as you say, an outsized impact of the pandemic or Russia against the resilience the kind of sector has shown and the bounce back in travel. And maybe honing in on the debt market, before thinking about Sky and the products you use, what's your assessment of the overall health of the aviation debt market more generally?
Yeah, I think that there's significant demand in the market for aviation debt across the board, whether it's bank debt, ABS debt, or private alternative lender solutions. So that is not a concern today. And in fact, I think what we're seeing more generally is people are gravitating toward asset-based credit whether it's through equity investments in our fund or actually owning the debt on the debt side of it.
And then from a product perspective, when you look at Sky, what products are you availing of?
So we would be a secured borrower exclusively. We use both bank debt and the ABS market. Just a month ago, we issued an ABS transaction, our third ABS transaction. We were very pleased with the results of that deal, pricing around 5.3% on the A tranche of that bond. Not only with the investor demand, but the depth, right? More than 20 investors in the deal. And so that gives us a lot of conviction heading into the next year that ABS market is healthy. It's there for the right servicers and well-constructed portfolios.
Yeah, and the ABS one's a really interesting one, and obviously slam again, I think, in the 2024 piece. What LTV-wise, A notes, just where did that kind of land for you? And is it something you might go back to and issue Bs on, do you think, or you'll just see how it evolves?
Yeah, I mean, we're happy with where the A tranche LTVs land. In the high 60s% generally is what the rating agencies give, and that matches up generally with what we can achieve in the bank debt market. No plans to immediately issue a B. We want to balance, right, the equity distributions that we can make to our investors with overall leverage, and so we're happy with where the market is today without the B tranche. I think those sub tranches become more attractive, frankly, as benchmark rates come down. So that will depend on our views on the trajectory of that over the next 12 to 18 months.
Yeah, and it's obviously been something that's bounced back strongly over the last couple of months, having been effectively dormant for north of a year. And to that point, I think if we see base rates come back 50, 75 basis points, lease rates hold, we could get a lot of activity in that space.
Yeah.
Do you think we'll get back into E-note territory anytime soon?
I think it will take a different shape, right? I think there were some structural challenges where the return hurdle expectations that were set for that E-note ultimately drove, in our view, too much risk taking, and that was exposed during the COVID environment. And so, I think it is a useful way for passive investors to get exposure to the asset class, but it probably needs a rethink in terms of the incentives between the issuer and ultimately the E-note holder. And return expectations relative to the underlying risk of these portfolios.
No, I fully agree with all of that. Moving on to the investor side, can I get your perspectives? Obviously, you've gone out the fund, you're dealing with the investor classes very significantly. Have you seen any evolution in the types of investors you guys are engaging with?
Yes, we have. Quite a big evolution over the last 5 years. And it's been really driven by the interest rate rise. When that interest rate rise started, the interest in private credit became tremendous from institutional investors. For the first time since the great financial crisis, investors could earn double-digit returns investing in debt. And early on, when it was unclear the trajectory of the interest rates, people wanted to be in short-term debt and they wanted to be in floating debt. Today, now that we're range-bound on interest rates and likely going to be declining over the next couple of years, we're seeing investors search for duration, search for investments that have lower correlation to broader fixed income markets. And asset-backed credit, which is where aircraft fit, is really the perfect solution for these investors in their portfolio. So whether it's endowments or sovereign wealth funds or family offices or high net worth individuals, they're all looking for investments that give them some income, downside protection, but the ability to earn equity-like returns. And aircraft really offer all three of those in a way that's hard to solve for with other real assets.
Yeah, that's really interesting, right? And to take that point on return expectations and, aviation as an asset class and how we're stacking up against alternatives, how do you find that conversation around the types of returns that the aviation product can offer?
I think it's really the lower volatility that we can demonstrate in the return profile that's attractive as much as the absolute return, right? The asset itself, the fact that the supply market is so tight, you can tell investors and show investors through COVID, hey, your downside is just very significant in this asset class, and your ability to outperform through the lease contract, add value through a lease extension or a marketing event can get you into that mid-teen return or better category where you simply can't achieve that in some of these other real asset classes.
And kind of layering a question relating to your debt and investor environment is really around climate challenge and ESG. How high or does it factor into your conversations with your debt providers and your investors?
Yeah, it's always a topic of discussion with our investors. It's not driving investment decision making today. Most of where we land with our investors is around reporting and what we're doing to monitor our portfolio. Talk about the initiatives that the airlines are doing with respect to ESG. We don't have any specific mandates formally in our investment committee or underwriting process around it. So I think there is a pragmatism from investors that, hey, the goals are ambitious. We may not get there, but aviation is essential. And so we want to see progress. We want to track it. And we want to have a discussion about what technologies are going to drive it. But we're not going to put specific mandates on how you can deploy capital. On the bank side, sure. I think the banks get credit internally and also as part of kind of how they think about how they want to promote their brand. They're willing to kind of give you a little bit of a carrot for those ESG-linked investments. But I would say, again, that's on the margin. It's not really a driver for how we make decisions. And so I think we've struck the right balance between we need to have the discussion, but we need to be practical about the realities of how we're going to go to net zero and the path to do so.
Yeah, I think that's very fair. And you're kind of looking at it and saying, we talk about it a lot, but is it actually impacting the size of the investor population or materially on your price of debt? And it seems at the moment the answer is no, particularly as we sit here in the US, right? Maybe a different answer when you talk to some European-based investors and the regulatory drive there. Maybe stepping on a wider lens on the leasing market, curious on your thoughts around what we might see from an M&A perspective or not. If we look over the last 3 or 4 years where consolidation has happened, maybe taking Avilease aside as a new platform that's put a lot of capital into space, it's been larger lessors swallowing medium-sized lessors.
Yep.
Not a bunch of transactions, but a number that have happened in that kind of 100, 150 aircraft piece. Do you think that's a trend we'll continue to see? And does that then imply that scale is of increasing importance?
Yeah, I think when you look back even beyond the last couple of years, 10, 15 years, the vast majority of these M&A transactions are $3 to $5 billion in size. They're either new entrants accelerating their entrance into the market, or they're medium-sized lessors trying to get into that top 10 or top 15, maybe make an order with the manufacturer. And so, I think the M&A market will continue to be in that range, $3 to $5 billion of size, probably 1 to 2 transactions. When you look at kind of the post-COVID M&A environment, you have some people that came into the market with the distress. They were opportunistic acquirers. They're now opportunistic sellers, but they're not forced sellers. And so we're seeing discipline from the sellers. We're seeing buyers that want to grow, but they're also being disciplined in their approach to growth as well. And so I think it's a healthy M&A market. What's going to drive it, either for more M&A or less M&A, is probably interest rates. We tend to see more M&A as interest rates come down. You get not just strategic players, but financial sponsors wanting to play when greater leverage is available in the marketplace, and also delays from the OEMs. Right, the longer term the impact of these OEM delays, the more lessors are going to need to use M&A to backfill for that growth that they would have otherwise achieved through new aircraft deliveries.
Yeah, and maybe looking at the larger players, the investment grade population of lessors, it's not very significant, right? But you're probably talking sub 10. You have a couple of players that are trying to get into that space, maybe the high yield market, building out their portfolio and size. Your thoughts on the importance of investment grade and how you think about the sector more broadly as an asset manager that's not going to kind of push for that rating, but do you think it's important that we get more aircraft lessors that are in that space because it just attracts more eyeballs to the space generally?
I see 2 paths for how growth of lessor business models is going to happen. I think there's the investment grade unsecured route, and I think there's the route that we're pursuing, which is growing through private institutional capital, primarily funds. And both are growing. And I think actually alternative asset managers are probably growing at a slightly faster clip, but those unsecured lessors are larger today. I think the question is that you have to ask yourself when you want to pursue an unsecured rating or a more permanent capital structure is, how does that drive your investment decision-making process and the timing around those investment decisions that you make to get that rating, right? It's great to make an order, but some orders are better than others. And so timing becomes pretty critical into how you think about scaling and driving for that investment grade rating. And certainly as an investor, I don't want the rating agencies driving how I think about what's a good investment. And so it really needs to be an output of what is sound investment decision making versus using that as a key input for how you're building your business.
Yeah, no, very understandable. So just in closing, Austin, and I always close with this one, but as we look out over the next 12 months, what are your optimism levels like?
I think when you go back to supply and demand, there's reason for optimism on both sides, right? Demand is still very resilient, very strong, double-digit RPK growth this year, and the supply side is relatively constrained. And so as an asset owner, we think our base case is lease rates and asset values will continue to stay where they are today, and probably they're skewed toward the upside where these supply challenges are going to take longer than people expect to correct themselves, and so asset values and lease rates should continue to go up. I think for ourselves, right, we try and use the flexibility of our business model and our capital base to really be able to react to these different macro opportunities or macro events that hit the industry and use our capital where it's most needed. And so over the last over the last 12 months or so, that's meant finding some interesting opportunities to refinance current generation aircraft on airlines' balance sheet, or the opportunistic MAX or NEO deal where the airline thought they had maybe another channel to finance that aircraft, and that fell away, and we were able to react quickly. And so, being able to do both current technology and new technology and really assessing the best relative value is a tremendous advantage in the marketplace today, because both are good investments, right? And both are core to the airlines, and it's really incumbent on the managers and the investors to really understand, which asset types ultimately are part of the long-term fleet plan of the airline, and that should be what's driving investment decision making. And so, I think we're going to see more capital come into this space, especially with investors searching for duration, right? Investments that offer duration, the ability to lock in contractual cash flow. That is what we see in terms of institutional investors wanting in their portfolio. And so we're quite optimistic about capital flows coming into the space. And I think the one challenge that we don't control, of course, is the OEM deliveries, right? And so, if they're able to increase production rates over the next 2 or 3 years and sort themselves out, that will further increase our optimism in terms of the ability to grow our portfolio.
Yeah, well, Austin, I would like to thank you as always for your time and insights, and wish you and SKY Leasing a very successful 2025.
Thanks, Joe.
Cheers.